Killed by fake profits. An employee sat frozen at his desk, watching the stock ticker crash in real time. Enron shares, once worth $90, were now trading for pennies. And the scary part? Just months earlier, the company's own executives had been telling everyone to keep buying. Let's back up. Enron used to be the poster child of American business. Energy company, sure, but by the late 90s it acted more like a Wall Street trading firm, buying and selling contracts on gas, electricity, even weather. Fortune magazine called it America's most innovative company 6 years in a row. Turns out, innovative was doing a lot of heavy lifting in that headline. Because behind the scenes, Enron was using something called mark-to-market accounting. That basically means you get to book projected future profits today, even if you haven't actually made a dime yet. It's like putting your expected lottery winnings on your tax return before you've bought the ticket. And when those projected profits didn't show up, Enron didn't fix the problem, it hid it. Executives created a web of separate shell companies, off-the-books entities used to bury billions in debt so it wouldn't show up on Enron's main financial statements. To investors, the company looked flawless. In reality, it was a house of cards, standing on other smaller houses of cards. For years, nobody outside the company knew. Then in 2001, journalists and analysts started asking simple questions Enron couldn't clearly answer, like, how exactly do you make money? When the hidden debt finally came to light, confidence evaporated overnight. The stock cratered, investors fled. Auditing firm Arthur Andersen, who was supposed to be the watchdog, collapsed too after its role in the scandal became public. In December 2001, Enron filed for Chapter 11 bankruptcy, a legal process for reorganizing or winding down debts. But this wasn't a company that filed for protection and quietly kept the lights on. Enron dismantled completely. Thousands lost their jobs, and many lost retirement savings that had been tied up in company stock. Some Enron executives were later criminally convicted for their roles in the fraud. A rare case where the guilt wasn't just public opinion, it was a verdict. The lesson here isn't just don't commit fraud, obviously. It's that complex financial structures designed to be hard to understand are usually hard to understand on purpose. If a company's own accounting requires a flowchart with 50 boxes and arrows, that's not innovation. That's a red flag wearing a suit. What do you think? Could regulators have caught this earlier? Or did everyone just want to believe the story? Drop your take in the comments. Subscribe. We post a new bankruptcy story every day. Which company's collapse do you want to see next? Write it in the comments.